In today's episode, I have four interesting stories to talk to you about. In the first story, I want to discuss some shady business that is going on in investment banking, especially around SMEs. In the second story, I'll talk a little deeper about personal loans and why they are slowing down today. In the third one, I'll talk about the home textiles industry of India and explain why it should be given a little more attention than it currently is being given. And the fourth and final story of the day is my personal favorite. I'll talk about how money is practically created from thin air and will also debunk some myths around money and how it is created. Welcome to the Daily Brief Show by Zerodha, where our aim is to give you news in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal. Today is Thursday, the 26th of September. In the first story of the day, I want to discuss some shady business that is going on in investment banking, specifically around SMEs. Some investment bankers have come under the spotlight because they have been closing under the table deals with SMEs. Let me explain how this exactly works. See, investment bankers first promise to help SMEs raise more money by inflating their company valuations. In return for this, they take a cut of the extra money that is raised. See, normally bankers charge a fee of about 1 to 3%. But with these backdoor kind of deals, these investment bankers who've come under the spotlight right now charge as much as 50% of the excess funds. Now, I know this may be a little complex to understand, so let me explain it with a simple example. Imagine there is a company that is worth 500 crore rupees. The investment banker in this case steps in and says, hey, we can make it look like you're worth 1,000 or even 2,000 crores. Then, based on this pumped up valuation, they raise extra money from investors, split the extra funds, and then disappear. Now, the company walks away with more cash than what it is truly worth. The investment banker pockets a big and fat paycheck, and the investors are left with overpriced shares that are probably going to fall in value very soon. Now, the scary part here is that this is not just a one off case. It started in Gujarat and Maharashtra, but now this practice is spreading all across India. SEBI, which is the market regulator, has already raised some red flags and issued warnings to investors, but by the time normally people realize what's happening, it is usually too late and the damage is already done. In fact, in the last year alone, SMEs have raised over 6,000 crore rupees through initial public offerings or IPOs. Almost half the money raised through SME platforms in the last one decade has come in the last 12 months itself. Now, this is surely a booming part of the market, but it is also raising some serious concerns for obvious reasons. So the question is, how did we even get here? See, the SME IPO market was originally created with good intentions. The idea was to make it easier for small companies to raise money without all the extra hassle of a regular IPO, which is expensive and comes with a lot of paperwork. Plus, banks usually are not too keen on lending to smaller businesses, and whenever they do, the interest rates can be really, really high. So that is why back in 2012, the NSE and BSE created special platforms just for SMEs to go public in the markets. But now, of course, this has not quite been a smooth ride. Some companies have found very clever ways to game the system. A perfect example is Verenium Cloud, which is a small tech company. In 2022, they raised 33 crore rupees through an SME IPO, saying that the money was going to help them grow the business. But SEBI dug deeper and found out that this money was actually being funneled into some very questionable deals. Verenium inflated their costs, shuttled their money around, and generally misled all their investors. Classic case of smoke and mirrors in a way. Now the question is, what is SEBI doing about this? Look, SEBI definitely knows that this is a serious problem and they have already started to crack down. Recently, NSE introduced a new rule saying that SME IPOs must show positive cash flow for at least 2 of the last 3 years before they can go public. The goal here is mainly to weed out all the companies that have weak financials so that they cannot take investors for a ride. And this is not just the case for SMEs under scrutiny. SEBI is also taking a long and hard look at investment bankers who manage these IPOs. The rules for merchant bankers have not been updated since 1992, which is almost a lifetime ago in terms of finance. SEBI wants to now ensure that only very serious and stable bankers are allowed to manage public issues. Currently, merchant bankers only need to have a net worth of 5 crore rupees, but SEBI is pushing to raise that requirement to 50 crore rupees for those handling larger deals. Now, this is a move that will ensure only experienced and well-funded bankers are in charge of these deals. SEBI also wants to limit what these bankers can do. Some of them are dabbling in other businesses like loan syndication and project advisory services, which creates many conflicts of interest. SEBI's goal here is to keep them focused on the securities markets only. But the tricky part is that SEBI over here is just trying to strike a balance. They want to protect investors without making it impossible for SMEs to raise money. If the rules are too strict, small companies could struggle to get the capital they needed to grow. But if the rules are too loose, we will keep seeing more of these fraudulent and inflated IPOs. So the question is, what does all of this mean eventually? Look, SEBI's changes to SME regulations and merchant banker oversights are definitely a step towards cleaning the market. But only time will tell if they can actually end up finding the sweet spot where companies can raise money fairly and investors do not get burnt. In the meantime, if you as an investor are thinking about investing in SME IPOs, here is a small piece of advice from us. Be very, very careful. The market is growing very fast, but with growth comes great risk, and right now there are plenty of red flags out there. Moving on to the second story, let's talk about slowdown in personal loans. Look, there is something interesting that is going on with personal loans and unsecured lending right now. The RBI, or the Reserve Bank of India, recently issued its September bulletin, and according to it, the NBFC sector in India seems to be seeing a big slowdown in areas of personal and unsecured loan. Let me try and explain what's exactly happening here. See, to begin with, it is important to know that unsecured loans make up a massive 26% of all the loans that are given out by NBFCs. So a slowdown in this area means a slowdown for the entire NBFC sector of the country. Now, this slowdown is not small or gradual. For NBFCs in the middle tier, the growth in unsecured loans has gone from being over 50% year on year some time ago to just about 10% right now. By the way, in case you're wondering over here, a middle layer NBFC is basically an NBFC with assets of over 1000 crore rupees. The difference is that they are subject to stricter regulations than smaller NBFCs, but not as heavily as regulated banks. Now, back to the slowdown, things are not just restricted to NBFCs here. Even banks and other fintechs are feeling a bit of a pinch. Personal loans, which were growing at over 25% earlier, are now growing at only about 18%. In fact, a recent report by TransUnion Sibyl says that new loans given out grew by just 3% in the quarter ending June 2024. To give you a comparison, this number was 36% just 1 year ago. So the big question is, what is exactly happening and why is there such a slowdown? Look, all of this started when the RBI decided to increase the risk weights on certain types of retail loans in November 2023. They made this move because they were worried about the fast growth in unsecured consumer credit and wanted to slow things down a little bit. But the result was that not just personal loans, but other forms of loans also took a hit. According to the same TransUnion report, credit card originations also dropped by a massive 30% year on year in the June 2024 quarter. Why? Look, a big reason is the rising default rates. Since credit card companies are now facing higher funding costs, they have started to tighten their policies by issuing fewer new cards, cutting benefits, and lowering credit card limits. But all that said, there is not all bad news here. There is also some positive light. See, even though personal loans and credit cards are struggling, there is growth in some other areas. According to data from RBI, loans in the agriculture industries are doing quite well now. So even though consumer credit is slowing down, there is a visible shift towards sectors like agriculture, which is a positive sign for us. Another area that is doing well is gold loans. This is especially true in rural areas where gold loans are seen as a quick and reliable way to get credit. These loans are growing at nearly 40% year on year as compared to just under 15% in April. George Muthoot, who is the managing director of Muthoot Finance, which is a Kerala-based gold loan company, told CNBC TV18 that since unsecured loans like personal and SME loans are harder to get, people are turning to gold loans. But coming back to unsecured loans, there are early signs of trouble with delinquency rates. According to a report by Cliff Highmark, delinquencies in the 30 to 90-day overdue category have gone up in both unsecured and secured loans. While personal loan delinquencies have stayed stable, credit card and small ticket loans are increasing. The TransUnion Sibyl Credit Market Indicator also highlights this. It says that even though credit performance has improved for most products, credit cards are the exception and delinquencies are on the rise here. Also, another interesting point to note here is that public sector banks are experiencing a sharper increase in early stage delinquencies as compared to private banks. Even home loans, which are relatively considered as a safer option, have seen delinquency rates rise from 1.9% in 2023 to 2.3% in 2024. Now, the question here is, why is this happening? See, broader factors like inflation, higher interest rates, and tighter liquidity are playing a major role here. These pressures are making it very hard for people to keep up with repayments, especially on unsecured loans, which are already risky by nature. Another interesting trend that is shaping up is in the auto loan space. higher value loans, which is about 20 lakhs or above, are growing very rapidly. Since the year 2020, the value of such loans have increased by 2.8 times and their volume has increased by 3.2 times. Now, this indirectly suggests that customers are increasingly leaning towards buying more premium vehicles. As a result of all of these issues, lenders are now becoming increasingly selective, especially with borrowers who do not have a strong credit history. The same TransUnion report shows that the share of first-time borrowers in loan originations fell to a record low of 12% in the June 2024 quarter from 16% a year ago. Lenders are simply not willing to take risks on first-time borrowers in the current situation. Now, moving on to the next story, I wanted to discuss a sector that is usually not given enough attention in our daily conversations, but is very quietly growing very steadily, which is the home textile industry. Trust me when I say it, there is more to home textiles than just bed sheets and curtains. This market is bigger than you probably think, and it is also growing faster than you would expect it to. So let me break things down, starting with some numbers. See, the global home textiles market was valued at 122 billion US dollars in 2022, and it is expected to hit 134 billion US dollars by the end of next year. And if we further look ahead to 2030, this market is expected to become a massive 185 billion US dollar market. So as a space, this is definitely something that investors like you and me cannot ignore. But the question is, what is really driving this growth? The short and very simple answer is that people are spending more and more money on beautifying their homes now. Just because people have been spending a little more time at home than they earlier used to ever since the pandemic, they are becoming increasingly inclined to invest in things like towels, bed linens, and other home essentials for their house. Now let me ask you a question. Can you guess which country leads the production in the home textile segment? No surprise, it is China, and it has about 23 billion US dollars in home textile exports. But the good news here is that India, with about $5.7 billion in exports, is growing fairly quickly at about 8 to 10% every single year. In India, 6 major companies alone control about 65% of this market, and they've held very strong even despite all global economic challenges. But the question is, why and how is India doing well here? Look, all of it comes down to the China plus one strategy. Let me explain. See, after the COVID-19 pandemic, countries have increasingly wanted to diversify their supply chains to avoid relying too much on China. And that is exactly where India has stepped in and started absorbing some of that demand. But it is not just about being an alternative to China. India is also going big on sustainability. Eco-friendly and organic products are gaining a lot of traction, and Indian manufacturers are stepping up their game with greener products in home textiles. But like everything else, not all things are rosy. Cotton, which is the backbone of the home textiles industry, has seen prices on a bit of a roller coaster ride. In 2022, prices went through the roof due to poor crop yields, and then by the end of the same year, they came crashing back down. Currently, things are relatively stable, but the volatility has caused a lot of instability for manufacturers who want to run a steady business. It's very simple, right? Whenever cotton prices spike, it eats into the profit margins for Indian companies that rely heavily on cotton products like bed linens, etc. Now, the hope here is that with more stable prices this year, the situation will calm down a little bit. Lastly, I also wanted to touch upon something that is affecting everyone: freight costs. Look, I've spoken about this in a lot more detail in some of the past episodes, so if you have been following the Daily Brief for a while now, you'll probably know how problematic shipping currently is. But for those of you who are new or who have missed our shipping stories, I'll give you a very quick summary. Look, lately, shipping has become ridiculously expensive because of global issues like the Russia-Ukraine conflict and the tensions at the Suez Canal, which act as a shortcut between Asia and Europe. Now, these problems have pushed oil prices up very significantly, and since shipping routes have become longer to avoid conflict routes, there is less hope for these costs to stabilize in the near future as well. For Indian home textile exporters, logistics costs have shot up by nearly 5 times in some cases because of these issues. So while the demand for home textiles is quite strong and the opportunity is also very large, these supply chain issues are making it very hard for them to turn a decent profit. Now, moving on to the fourth and possibly my favorite story of the day, I'll talk about how money is practically all imaginary. Look, recently Arundhati Bhattacharya said something very interesting during an interview with CNBC. You probably know Arundhati Bhattacharya as the former head of the State Bank of India. The thing is, given her experience and stature, whenever she talks about something, people tend to listen. In the interview, she pointed out that Indians are no longer relying on bank deposits to save and grow their money. She thinks the younger generation is now more into investing in the capital markets. Basically, she feels that this could cause the end of the deposit-led banking era. Now, this is not just her view. Even the RBI governor, Shaktikanta Das, has been saying very similar things. He's mentioned how alternate investment options are now becoming more attractive to people, especially retail customers. The result is that they're keeping less money in banks. Now, here's the thing. These comments are popping up just as banks are experiencing something very unusual. Deposits are not growing as fast as the loans they've been giving out. In the last 2 years or so, while credit grew at 15% and 20% in FY23 and 24 respectively, deposits grew much slower at only 9.6 and 13.5% respectively. So the big question here is, are people pulling money out of banks and moving it into the stock market? And if they are, what does this mean for the loans banks can offer? I'll explain. See, on the surface, it all makes sense. If you're putting your money into stocks or mutual funds, you naturally have less money sitting in your savings account. But it is more complicated than that. In a way, what makes sense for just one person does not always add up when you look at the bigger picture. Here is an example to explain this. Let's say you decide to invest in a mutual fund instead of letting your money sit in your savings bank account. Where does your money go? It just moves from your account to the mutual fund's account. As simple as that. Then, if the mutual fund buys a stock, the money moves again, this time to the seller's account from the mutual fund's account, and so on and so forth. Now, in other words, the simple way to look at it is that the money never really leaves the banking system. It is always essentially sitting in someone or the other's account, even if it is not yours. So, on a larger scale, if you think about it, the total deposits in the banking system don't really decrease just because people are investing. The money is just changing hands in a manner of speaking. But the thing is, even though people's investments are not really pulling money out of the banking systems, deposits are still growing slower than loans. Now that seems confusing, right? Aren't banks supposed to use the money people deposit in order to lend out money? Look, not exactly. The way banks handle money is a bit weird. They don't need your deposits to give out loans. Loans actually create deposits. Again, this sounds confusing? Let me explain. When a bank gives someone a loan, they don't really hand them a bag of cash. They credit the borrower's bank account with the loan amount. And that shows up as a deposit. In a bank's world, every loan is just a new entry in the system, as is every deposit. So when a bank lends money, it is not really pulling that money out from its savings account. It is basically creating new money out of thin air. So no, banks are not literally taking money from one person's deposit to lend it to another one. The money did not even exist before the loan was issued. But now you might be thinking, this is crazy, right? If banks can create out of nothing, what is stopping them from giving unlimited loans? Look, that is where the RBI steps in. And this is important to know. See, since most money is just numbers in a bank system, the RBI makes sure that banks do not go too wild in this. Banks have to follow certain rules. They can only lend a certain percentage of their total assets. For every loan they make, they have to set aside a little bit of money, some in cash, some with the RBI, and some with other banks in order to make sure that they can settle any debts quickly if ever needed. Now, this system keeps everything under control. It ensures that banks cannot just make endless amounts of money. Whenever they lend, they have to lock up some actual cash or assets in order to meet the RBI's requirements. If you take a look at the balance sheet of HDFC Bank, for example, you'll see their advances, which is loans on one side, but you'll also see that they have a chunk of assets in the form of cash, balances within the RBI, and balances with other banks. Now that is the cost of doing business for them, is the price they pay for giving out loans. But then the question is, where do banks get the extra money they need in order to back up these loans? There are several options. The cheapest source is the money you keep in your savings account. Then there are also fixed deposits which cost them a little bit more. But if they need even more money beyond that, they can always issue bonds, tap into money markets, or raise equity. But these options again come with much higher costs. And this is exactly the real issue everyone is concerned about. The thing is, money is not disappearing from the bank systems. Banks are also not running out of funds to lend. But banks are giving out so many loans that they have to dip into more expensive and less stable sources in order to keep up with the RBI's requirements. As more people invest, banks are finding it more and more harder to attract the cheap money that they once used to rely on, like savings or fixed deposits. That is making their business riskier and tougher to manage over time. So while India is definitely getting smarter about investing, banks are having to fight much harder for their share of the pie. Moving on to the last section of the day, which is the small news tidbits. First, Swiggy has received SEBI's approval for a 10,375 crore rupee IPO. The company will raise 3,750 crores through a fresh capital and 6,664 crore rupees via offer for sale. This move will intensify competition in India's food delivery market where Swiggy competes with Zomato. Second, IIFL Finance plans to raise 10,000 crore rupees by issuing bonds after the RBI lifted its ban on gold loans. The company is diversifying its funding sources and expanding into areas like SME loans and other business segments. Third, after massive chaos during the Coldplay concert ticket bookings, BookMyShow and Zomato Live have taken legal action against resellers like Viagogo. This step is aimed at combating ticket scalping and protecting consumers from inflated prices. Fourth, Airtel has launched India's first AI-powered network-based spam detection system. It offers real-time alerts for suspected spam calls and messages, processing billions of daily interactions to enhance security without requiring any form of action from the users. Fifth, Commerce Minister Piyush Goyal highlighted India's growing role in high-tech manufacturing and the importance of quick commerce platforms partnering with Kirana stores for sustainable last-mile deliveries. This is being supported by the ONDC initiative. That's all the news and stories I have for you today. I hope you found value in today's episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.